You think that the underperformance in this crowded trade club will continue?
I actually think the term crowded trade could be extended well past the FANG and technology stocks. If you look at where fund flows have been for the last several months, they've actually favored energy more than anything else. So, when I think of crowded trade, the tech stocks are unloved, including Microsoft. It's the cyclical stocks that I think if you want to make the argument that they're crowded, that's where they're crowded. Having said that, I'm really not worried about crowded or fund flows because at the end of the day, the fundamentals do support, and those fund flows across the board are being generated by easy money that's just not going to stop anytime soon.
Don't crowded trade. Crowded trades. I understand what you're saying about energy, Jim, but crowded meaning that it's more than 10% net long in the hedge fund community. That there's major positions in a lot of these stocks. Pete, doesn't that impact how these stocks trade and whether or not we see this underperformance? I mean, if you're an individual investor, you got these names, and they do extend well beyond the big cap tech stocks. Jefferies does include Activision Blizzard, Twilio, MasterCard, et cetera, et cetera. There's a long list of them. But shouldn't you be worried about hedge funds, how hedge funds move in and out, particularly around quarter ends?
And especially because of the fact that, Mel, we're always backwards looking when we're talking about these hedge funds and what their positions are, and maybe they're shifting around themselves. So, yeah, I mean, quite honestly, I still just go back to the fundamental story all the time, Mel, when I'm looking at these various companies and just look at it and try to make sense of it and whether or not are they stretched, are they not. I mean, one good example from the very top of the show we were talking about, there are some names out there that, whether or not you want to put in the Pelotons, the DocuSigns, all the rest of those. Those are the stocks that, and Josh was referencing this as well. Those are the stocks where we've seen a lot more of that pressure, and we see these significant moves to the downside because they either had no PE or an extremely high PE. But I think you still have to look for quality. If you can find quality and it's trading at a reasonable PE level, I think that is the place to be. And whether or not the hedge funds are there with you or not, I don't get as concerned about it then, because I think the reality is too many people have been chasing. And they've been chasing that incredible run to the upside that they feel they're going to get out of the next stock that comes public and the next stock that everybody says is the stock to have. And yet, as we're coming out of the pandemic, to some degree at least, and vaccines continue to get out more and more, we are starting to see which are the quality names that are going to be able to continue forward and which are the names that did extend way too far that probably don't still have that upward movement potential that everybody thought they once did. So I think you've got to really shift around in a big way these days to find the correct quality names that still trade with a PE that makes sense.
This market, as Peter mentioned, throughout the pandemic has been a market of crowded trades working. If you weren't in the trades, you were not performing or outperforming the indices. But Josh, I feel like you've got a pearl of wisdom about how to regard crowded trades in this market.
I'm sure there's somebody out there who makes money based on obsessing over what other people are doing. I just haven't met that person yet. But I'm only in this business since 1997. So it may just be that I haven't searched long enough and met enough traders. The reality is, if you focus on your investment strategy, whether it's dividend income or it's growth at a reasonable price or it's diversified growth or it's rebalancing, like if you focus more on getting that part right and having an appropriate asset allocation for the amount of risk you want to take, there will be stocks that you end up owning that are crowded. Like, it's unavoidable, especially if you own high-quality companies. But in the end, things that are fads and they fade out and they fade back in, we've seen it over the years with solar, we've seen it with semiconductors, biotech. There's always going to be the in group of stocks, and then they'll go out and they'll come back again. It's really important that you not make buy and sell decisions, especially over the long term, based on that kind of thing. Now, if you're somebody that's writing an algorithm and you want to fade other people, that's probably not most of our audience. So just back to the Google example, over the last 10 years, if you just focused on the fact that Google is growing its revenue and earnings faster than the market and is not really outrageously expensive, you've turned $10,000 over the last 10 years into $70,000. That same $10,000 invested in the S&P 500 value ETF really only turned into $22,000. Both returns are fine. There's nothing wrong with doubling your money from 10 to 22, but 10 to 70 is better. All you had to do, though, was sit through these periods where people looked at Google and said it's crowded. If you could avoid that kind of stuff and just focus on why you bought it in the first place, I think you came out okay.